Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Mark Marex, product development specialist with Nasdaq Index Research, to discuss the Nasdaq Next Generation 100 ETF as it crosses the $1 billion asset under management threshold. That's impressive, Mark, considering it just launched last quarter. Let's take a look at your first two slides and discuss overall performance.
Yeah, thanks, Joe, and great to be back on such a momentous day. We crossed the $1 billion threshold officially right after the close on Friday. And just to give folks a little bit of background, this ETF from Invesco, ticker QQQJ, tracks the Nasdaq Next Generation 100 Index, which we launched back in August. So the ETF launched about 2 months later in October. And this shows you the performance since that launch on October 13th. Pretty tremendous, right? I mean, we already had a great year, generally speaking, for NASDAQ indexes and for the market coming into October. We're up 30% on this index since that ETF product launched. This is as of Friday's close. And important to note that this is despite, most of this period has been kind of a rebound in terms of values, performance versus growth on a relative basis. A lot of value trades have been outperforming during this period, and especially small caps and mid caps. So you can see the competitor indexes here. In gray, we've got the S&P Mid Cap 400, which is basically about half value, half growth names. Still not outperforming this index, which is heavily growth. And then the Russell Mid Cap Growth is, quite meaningfully underperforming. So really a pretty impressive record of performance 4 months out of the gate, and you can see at the very bottom there more than doubling what's going on with the Nasdaq 100. So with that, let's move on to the next slide. This one will show you just, again, launched the index in August, but we did a bunch of simulated, back testing to look at the performance historically going all the way back to 2010. So you can see for 2020, what I've highlighted there, that's a mixture of simulated through August and then live returns from August through the end of the year. Almost 41% on this index, not quite as good as the NASDAQ 100, but not far behind, and then easily performing those other two mid-cap competitors. You can see also most calendar years in this graph, the Next Gen is the top performer or, pretty much tied for first with one of the others.
Mark, how about individual sector performance?
Yeah, so great question. This is I think one of the really interesting things about this index is we talk about the NASDAQ 100 being really overweight tech, right? And that tends to average 55, almost 60% in terms of sector exposures to tech when you're looking at ICB classifications. This index is only about a third tech, right? Kind of right in line with the Russell Mid-Cap Growth. You can see way more heavily weighted to tech than the S&P Mid-Cap 400, but not as concentrated in tech. You've got really solid consumer exposure, healthcare at 20%, even industrials at 12% on this index. So it's a much more balanced index in terms of sectors. Again, no financials, just by way of methodology. Very minimal sort of oil and gas, utilities, basic materials, all those kind of old 20th century sectors, like we like to refer to them. So more concentrated still in the innovative kind of knowledge economy sectors, but not as strongly concentrated in tech as the NASDAQ 100.
And Mark, finally, my last slide, also one of my favorite slides, R&D and investing money back into the business and how that translates into returns.
Yeah, so I think, the investors that have been pouring money into this index kind of recognize that it is unique from some of the other mid-cap products because of the innovation bent of the companies that list with NASDAQ. So here, I mean, it's very obvious visually, right? When you plot it back going 10 years, you look at R&D annual expense as a percentage of company revenues and total that up on an index basis, we're averaging about 2, sometimes even 3x the rate of revenues being reinvested into R&D for this index. Sometimes that, kind of gives you a misleading indicator in terms of thinking these companies are expensive because their earnings are quite low and their valuations are high. But what's really happening behind the scenes is they're spending that money that they're taking in, reinvesting it internally as opposed to paying out in terms of dividends or buybacks. And that's kind of feeding this self-fulfilling cycle of innovation and growth. So that's the next gen.
All right, Mark, appreciate the insight. Thanks for joining us on Trade Talks. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.